Welcome, dear students, to the massive open online course on money and financial markets. In today's module, we are going to talk about financial inclusion. The objective of this module are as follows. We would have a brief overview of financial inclusion around the world, and we would also discuss about the benefits of financial inclusion and how they can promote inclusive growth in an economy. We would be summarizing all the related empirical evidence that are available, and we would also outline some of the challenges to realizing the benefits of financial inclusion and directions for future research. And at the end of this module, we would like to talk about the initiatives that has been taken for financial inclusion both by the Government of India and by the Reserve Bank of India. Now, what do we really mean by financial inclusion? Because it is a very broad concept with several definitions in literature. However, the definitions depend on the country's level of socio-economic development. Leysen and Thrift in their 1995 article made a very early attempt to identify what is financial exclusion. They defined it as a process that prevented individuals from disadvantaged backgrounds from accessing the financial system. So this was the concept of financial exclusion. Demirguk, Kant et al., they defined financial inclusion by having a bank account. People who have a bank account are basically financially included, and they also use it regularly. They can make payments easily and affordably. That is what they meant by financial inclusion. So basically, financial inclusion is a process to ensure the ease of access, availability, and the use of formal financial services for all the sectors of the economy. So if we try to summarize what financial inclusion is all about, it basically means that adults have access to and can effectively use a range of appropriate financial services. So financial inclusion encompasses access to credit from formal financial institutions that allows adults to invest in educational and business opportunities, as well as the use of formal insurance products that allows people to better manage their financial risks. The World Bank has also given the definition of financial inclusion, which also considers the concept of financial sustainability and the needs of the individuals. Financial inclusion, according to the World Bank, means that individuals and businesses have access to useful and affordable financial products and services that meet their needs, like transactions, payments, savings, credit, insurance, and they are delivered in a responsible and in a sustainable way. So basically, when the World Bank talks about financial inclusion, it basically talks about it to be done in a sustainable manner. Roughly, there are around 2.5 billion people in the world who live on less than $2 a day, and they are destined to live in chronic poverty. Every few years, we find that somewhere between 10 and 30% of the world's poorest households somehow, by one way or the other, try to manage to escape poverty. Typically, this is generally done by finding steady employment or through entrepreneurial activities such as growing a business or improving agricultural harvests. During that same period, however, we find that an equal number of households again slip back into poverty. So, health-related emergencies have always been the common cause, but there are many more causes like crop failures, like livestock deaths, farming equipment breakdowns, and even wedding and ceremonial expenses. In many situations, financial tools such as personal savings, insurance, credit, or cash transfers from families and friends are important buffers against such crippling setbacks. However, we also notice key market failures such as imperfect information, behavioral biases, high transaction costs, property rights which are not enforceable, and lack of competition create wages that inhibit the delivery of these traditional financial services. And also the volatile income and the subsistence status of the poor also exacerbate the situation and welfare implications of these market failures. Now, when we talk about financial inclusion, we find that several countries consider it as a critical determinant of a country's economic development, and hence it attracts global attention from academicians and policymakers for economic policy making. And the most important aspect of financial inclusion is its measurement. How do we measure it? The relationship between financial inclusion and other factors need appropriate measurement of financial inclusion. Similar to the definition of financial inclusion, there is no consistent methodology that can be applied for measuring the extent of financial inclusion in a country. In the literature on financial inclusion, we generally find two methods of measurement. One, which is based on individual indicators, and second, which is basically a composite financial inclusion index. Beck, Damerguk, Kant and Peria in their 2007 article were the first to measure a country's access to the financial sector and design new indicators on banking access for three types of services, including deposits, lendings and payments, using two dimensions. The dimensions that they used were access and use of financial services. This approach provided valuable and useful information about an economy's access to the financial system and specific dimensions of financial inclusion. However, it was really difficult to combine these factors for an overall assessment of the level of financial inclusion achieved by the countries. Furthermore, we also have worldwide database, such as we have the Financial Inclusion or the Financial Access Survey, which is called FAS, published by the IMF. We have the Global Findex Survey, published by Findex of the World Bank. They all describe financial inclusion using various types of financial services, access indicators such as the number of bank branches, the number of ATMs, the number of deposit accounts and outstanding deposits or loans. Using these databases, a composite index called the Financial Inclusion Index that measures the degree of financial inclusion can be constructed. Several studies also measure the level of financial inclusion following this approach. So, among them, the popular Financial Inclusion Index is basically a composite index built on the lines of the Human Development Index or the HDI. Now, if I talk about the Indian approach of financial inclusion, the Indian approach is based on the fundamental principle of 5 A's of ensuring adequacy, availability, affordability, accessibility. And the policy approach that is adopted for financial inclusion in India are basically two. One is called the minimalist approach and the other is called the expanded approach. Now, what is the minimalist approach? The minimalist approach for financial inclusion focuses on the provision of a bouquet of basic financial services and products, including thrift, credit, remittances and payment facilities for the vulnerable and the financially excluded sections of the society. Banks have been urged to include products like savings cum overdraft products, remittance product, pure savings product and entrepreneurial product while pursuing the objective of greater inclusion of every section of the society. While on the other hand, we have the expanded approach of financial inclusion, which focuses not only on the provision of basic banking products, but also on other ancillary financial products such as general insurance, health insurance, micro pension, mutual funds, etc. And this expanded bouquet of financial inclusion would also entail focus on consumer protection and education, particularly financial literacy for the new entrants to the formal financial system. While we talk about measurement of financial inclusion, one of the common measure of financial inclusion is the percentage of adult population having bank accounts. And another one is the Financial Inclusion Index developed by Sharma in 2008 in one of the working papers of ICRIER. The index developed by Sharma is based on three basic dimensions of an inclusive financial system. They are bank penetration, availability of the banking services, and usage of the banking system. What is banking penetration? It basically measures the depth of financial inclusion. It is basically the ratio of bank accounts to the total population in the economy. When we talk about availability of the banking services, it is basically the number of bank outlets available per 1,000 people to deliver the financial services. The bank outlets may include brick and mortar structures, it may include the ATMs, or it may also include the business correspondents. And the third measure or the third parameter, which we call the usage of the banking system, it goes beyond mere opening of accounts. It is evaluated on the basis of outstanding deposits and credits. So basically, the usage of the banking system is measured by the number of outstanding deposit and credit as a proportion of the net district domestic product that is used for measuring this dimension. After talking about how to measure financial inclusion, let us talk about how financial inclusion can affect the society or the economy. It can really help to reduce poverty and inequality in an economy. It can help people invest for their future. It can smooth their consumption, and it can also help to manage their financial risks. Many low-income adults rely on informal financial services. Access to formal financial services allows people to make financial transactions more efficiently and safely, and helps the poor people to climb out of poverty by making them possible to invest in education and business. Vis-a-vis, if people have access not to formal financial services but rather to informal financial services, they may be duped and they may not bring themselves out of poverty. So by providing ways to manage income shocks like unemployment or the loss of a breadwinner within the family, financial inclusion can help people, prevent people from falling back into poverty in the first place. And this is especially relevant for those people who live in the poorest of the households in an economy. There are also other ways by which financial inclusion can benefit a society, like the point of shifting payments from cash into account allows for more efficient and more transparent payments from governments or businesses to individuals, and also the other way around, from individuals to government or businesses. And access to formal financial system and appropriate credit can potentially facilitate investments in education and business opportunities, and could in the long term boost economic growth and prosperity of the economy. We have just touched the tip of the iceberg when we talk about in what ways financial inclusion can be beneficial for an economy, because the benefits from financial inclusion can be wide ranging. For example, if I talk about certain empirical evidences, we find that studies have shown that mobile money services, which allow users to store and transfer funds through a mobile phone, they can help improve people's income earning potential and thus lead to a reduction in poverty. A study that was found in Kenya found that access to mobile money services delivered big benefits, especially for women in the economy. It enabled women-headed households to increase their savings by more than 1/5. It allowed 1,85,000 women to leave farming in Kenya and develop business or retail activities. And it helped reduce extreme poverty among women-headed households by around 22%. So digital financial services can also help people manage their financial risk by making them easier to collect money from distant friends and relatives when times are really tough for them. In Kenya again, we found researchers have found that when they're hit with an unexpected drop in income, mobile money users did not reduce their household spending, while non-users and users with poor access to the mobile money network reduced their purchases of food and items by around 7 to 10%. So digital financial services can really lower the cost of receiving payments, and a major example of this is another African country called Niger. So here we find a huge array of empirical evidences from all over the world where financial inclusion did really help the people come out from poverty. Financial services can also help people accumulate savings and increase spending on necessities. Huge examples of these are people from Kenya, Nepal, Malawi. So we find financial inclusion doing a lot in these economies. For governments switching from cash to digital payments, this can help to reduce corruption and improve efficiency. When we talk about India, in India, the leakage of funds for pension payments dropped by 47%, around 2.8 percentage points, when the payments were made through biometric smart cards rather than being handed out in cash. So we really find that because of financial inclusion, the path to economic development of an economy really gets smoothened up. Now, if we talk about other empirical evidences like regarding the percentage of account ownership and so on around the world, we find that the World Bank have the Global Findex database, which shows that around 515 million adults worldwide opened an account at a financial institution or through a mobile money provider between the years 2014 and 2017. That's the time that the database talks about, these years. This means that around 69% of adults now have an account, up from about 62% in 2014 and 51% in 2011. In high-income economies, 94% of adults have an account, and in developing economies, around 63% of the adults do have an account. There is also widespread variation in account ownership among the individual economies. In terms of mobile money accounts, the vast majority of account owners have an account at a bank, a microfinance institution, or another type of regulated financial institution. While sub-Saharan Africa is the only region in the world where the share of adults with a mobile money account exceeds 10%. Now, there, however, has been a persistent inequality in account ownership. While 72% of men have an account, 65% of women only have an account. So there is a divergence between men and women, a gender gap of around 7 percentage points. In developing economies, the gender gap remains unchanged at 9 percentage points. Among adults in the richest 60% of households within the developed economies, around 74% have an account. But among those in the poorest 40%, only 61% have accounts, leaving a global gap of around 13 percentage points. So now we can ask ourselves this question, that why do 100% of the population not have accounts, or why don't they use accounts? Empirical study have revealed that number one reason is having too little money. They say that 2/3 of the people have cited this as a reason for not having a financial institution account, and roughly a fifth cited it as the sole reason, that they don't have money to open an account or they don't have money to keep it in their account. Cost and distance. These were also cited by around 25% of the respondents, and a similar 25% have said that they do not have an account because a family member already has one account, so I don't need to have an account. So that was another response from them. Lack of documentation and distrust in the financial system. This was also cited by around a fifth of the adults without a financial institutional account, and around 6% cited that they do not have a bank account because of religious reasons. Another benefit of financial inclusion can be explained in terms of power imbalances. Now, power imbalances and different savings priorities between men and women can depress the household savings rate. So it is always beneficial for women having a savings bank account in their own name, because it can help or increase the ability of a woman to save, invest in household durables, and also empower her in household decision making due to the greater control and restricted access to other savings accounts that the man in the house holds. Now, coming to the end of this module, we would like to talk about what are the directions or recommendations that can be made for financial inclusion. To fully realize the benefits of financial inclusion, financial products first and foremost need to be tailored to the needs of the people to be relevant and make a difference in their financial lives. This also includes consumer education and protection to build and ensure trust in the formal financial system. On a more fundamental level, realizing the benefits of financial inclusion depends on an adequate financial infrastructure and a regulatory environment that is conducive to innovation, making small financial transactions economically viable and ensuring a safe, stable and reliable financial system. And it also relies on a financial infrastructure that is complemented by an enabling general infrastructure, including an ID system and a reliable ICT connectivity throughout the country to ensure that financial services can reliably reach beyond urban centers. Advances in technology have made it possible to deliver financial services in new ways and will continue to change how financial services will be delivered. As financial services change, so might their potential link to economic development. So, in addition to deepening the research agenda on the impact of financial inclusion on household income and vulnerability, another important dimension should be to link the micro level evidence of the benefits of financial inclusion to the macro level goals such as economic growth, and also we would like to have or we would like to see financial inclusion lead to a fall in inequality and poverty. As I have already said before, the government of India have taken certain initiatives for financial inclusion. Like they have tried to institutionalize the framework for banking correspondence, enhancing the access of banking services. The RBI have advocated a combination of brick and mortar structure with a mouse and click technology, extending financial inclusion in geographically dispersed areas. Banks have also mandated to open physical branches in all villages which has a population above 5,000. Banks were also mandated to open at least 25% of the new branches in unbanked rural centers. KYC procedures were simplified for opening accounts for persons with balances not exceeding 50,000 rupees. RBI has also granted in-principle approval to some entities to set up differentiated banks, which are generally called the small finance banks and the payments banks, to further the cause of financial inclusion in the country. And these banks, they also provide credit to small businesses, small business units, to marginal and small farmers, etc. There is also a strong linkage between financial inclusion and the payment system. RBI encourages the use of mobile banking, digital wallets, operationalization of the Aadhaar breach payment system, and which is called the ABPS, and the Aadhaar enabled payment system, which is called the AEPS. If we look at it from the demand side intervention, we find that banks in India have been mandated to set up financial literacy centers, which are called the FLCs, for extending financial literacy. The Rural Self-Employment Training Institutes, RSETIS, have been set up by various banks all over the country at the district level. And finally, most importantly, RBI has also reconstituted Inter-Institutional Financial Inclusion Advisory Committee for undertaking continuous review of the policies on financial inclusion. Thus, we can conclude this module by saying that financial inclusion do have a huge potential for ensuring economic development of an economy, and hence the Government of India as also the RBI should pay heed to these and take up all measures that is possible to ensure financial inclusion, a complete financial inclusion for the whole of the Indian economy. Thank you.